There is this kind of default setting in American corporate life. It's like this unwritten script you get handed the second you walk across the graduation stage.
Right, the classic American dream template.
Exactly. You
Yeah.
get the job, you climb the ladder, you upgrade your apartment, upgrade your car, you max out your 401k if you can afford it, and then you just sort of cross your fingers and hope that by the time you're 65, the math magically works out so you can finally stop grinding.
Yeah, and for a lot of people, that math is looking pretty shaky right now.
Totally. But what if that script is entirely optional? Like, what if the math to opt out of the rat race doesn't actually require a lottery ticket or, a massive inheritance or a trust fund?
That's the million-dollar question, literally.
Right. So today we're doing a deep dive into Kristy Shen and Bryce Leung's book, Quit Like a Millionaire. We're also bringing in historical market data, economic studies on the FIRE movement, which is financial independence, retire early, just to see if the map of retiring, like decades ahead of schedule, actually holds up in the real world.
And I'm so excited for this one because this book, it operates as this highly mathematical, incredibly pragmatic blueprint. I mean, Shen's core thesis is that escaping the daily grind is completely attainable for average earners.
Which is a bold claim.
It is, but she backs it up. You just have to treat your life choices like a balance sheet, essentially. It requires aggressive saving, highly strategic investing, and a frugal lifestyle. But the ultimate destination here isn't just seeing a massive number in your Vanguard account.
Right. It's not just about hoarding cash.
Exactly. The goal is to adopt what she calls a freedom mindset. You are optimizing for agency. The real currency you are accumulating is your own time.
I love that because I look at the typical financial advice out there, and so much of it is centered around, like, extreme deprivation. It's that classic trope, stop buying $6 lattes, stop buying avocado toast, and eventually, somehow, you'll be rich.
The latte factor.
Yeah. Which just feels a bit hollow when, the average rent in a major U.S. city is absolutely through the roof. A coffee isn't keeping you from buying a house. So Shen's approach feels fundamentally different because she doesn't start at the coffee shop. She starts with the structural foundation of your life,
Right.
way before you even have a paycheck to spend.
Yeah, she bypasses the whole latte shaming thing entirely.
Oh.
Her framework begins with the very first major financial decision most Americans make, which is, of course, your education and your career selection.
Right.
And her stance here is fiercely contrarian, especially when you look at modern American cultural narratives. I mean, she takes an absolute sledgehammer to Steve Jobs' famous Stanford commencement speech.
Oh, the follow your passion speech.
Exactly, where he told an entire generation of graduates to, just follow your passion and everything else will work out.
Which is universally seen as this empowering, inspiring mandate. But if you really think about it, especially through the lens of the current student loan crisis, it's pretty easy to see the flaw there.
Oh, it's a massive flaw.
Because if you don't have a financial safety net, following a passion that has zero market value is essentially a fast track to poverty. You take on, 6 figures of debt for a degree in a highly niche artistic field, and suddenly you're trapped in the exact rat race you wanted to avoid just to make the minimum monthly payments on your loans.
Shen argues that follow your passion is actually dangerously misleading advice for anyone who is starting with financial insecurity. She advocates for a radically pragmatic approach to career selection. She basically says employability has to take absolute precedence over passion.
And she has a math formula for this, right?
She does. To strip the emotion out of this choice, she uses what she calls the pay over tuition method, the POT method.
So instead of asking yourself, what do I love doing? You evaluate college degrees based on cold, hard numbers. You take the median starting salary a specific degree provides, and you divide that by the total cost of the tuition to get that degree.
It's pure return on investment.
Exactly. You are literally calculating the ROI of your education before you take out a single loan. It treats higher education not as this 4-year journey of self-discovery, but as a capital investment.
And the rule is simple. The higher the POT score, the better the investment. So a degree in computer science from a state school might have an exceptionally high POT score, whereas a degree in, medieval literature from an expensive private university would have a terrible one.
But let me push back on this a little bit, just playing devil's advocate. If everyone just chases the most mathematically efficient degree, say accounting or software engineering, aren't we risking a massive burnout epidemic? Like people spending 40 hours a week in jobs they absolutely hate just because the spreadsheet told them to do it.
It's a fair question, but Shen's response is that passion simply doesn't pay the rent. When you're dealing with financial insecurity, the chronic stress of just trying to survive completely overrides any joy you might get from a passion project.
Yeah, it's hard to be creatively fulfilled when you're terrified of getting evicted.
Exactly. Shen's philosophy is all about sequencing. Financial stability comes first, period.
Hmm.
Once you secure that high-paying, pragmatic job and you build actual wealth, you buy yourself the freedom to pursue your passions later, on your own terms.
Oh, I see. So you aren't abandoning your passion, you're just funding it.
Yes, you're building the runway before you try to take off.
Okay, that makes sense.
Yeah.
So let's assume you do this. You run the POT method, you get a highly employable degree, and you secure a pragmatic, high-paying job. Now you actually have surplus cash. But leaving it in a traditional savings account is like trying to walk up a down escalator,
It's a losing game.
because inflation is constantly pushing your purchasing power backward while you stand still, so you have to invest it.
And this is where we get into the real engine of wealth building, the debate between passive index investing versus actively managed mutual funds. Shen is a massive, massive advocate for passive investing.
Because an actively managed fund is where Wall Street professionals are constantly buying and selling stocks on your behalf, right? Trying to beat the market average and charging you high management fees for their supposed expertise.
Right. They sell you on the idea that they can outsmart the market.
Which always reminds me of hiring an incredibly expensive personal trainer who mostly just stands there watching you run on a treadmill.
Yeah.
I mean, you are paying massive fees for someone who, statistically speaking, isn't actually getting you better results than you'd get on your own just buying a broad market index.
That is a perfect analogy. Those fees are the silent killer of wealth. Even a seemingly small fee like 1 or 2% annually completely devastates a portfolio over 30 years because of the loss of compound growth.
Right, because the money you pay in fees isn't just gone today. You also lose all the future growth that specific money would have generated over the next 3 decades.
Exactly. Index funds solve this. An index fund passively tracks a huge basket of stocks. So the S&P 500, for instance, tracks the 500 largest U.S. companies. Your Apples, Microsofts, Amazons, Nvidias.
And because it's just a computer algorithm tracking a list, there's no highly paid manager in a corner office. So the fees are microscopic.
Microscopic. And it essentially eliminates individual company risk. An entire broad market index cannot theoretically crash to zero unless the global economy completely ceases to exist.
At which point, your brokerage account balance is probably the least of your worries. We'd be trading bottled water and canned beans anyway.
Yeah, exactly. And, Warren Buffett famously won $1 million bet, proving exactly this point.
Oh, I remember this.
Yeah, he wagered that a simple, low-cost S&P 500 index fund would outperform a basket of highly complex, incredibly expensive hedge funds over a 10-year period, and he won easily, entirely because the hedge funds' high fees ate away at their returns.
So to structure this engine, Shen advocates for a specific asset allocation, a 60% equities or 40% bond split. And she emphasizes doing this through ETFs, or exchange-traded funds.
Right.
For anyone listening who might be unfamiliar, an ETF is essentially a basket of hundreds or thousands of different stocks or bonds, but it trades on the stock market like a single share of a company. You can literally buy a piece of the entire U.S. economy with one click on your phone.
It's incredibly efficient.
But the 60-40 split is what's really doing the heavy lifting here, right? I mean, equities provide the growth, but bonds are doing something mechanically different.
Yeah, bonds act as the shock absorbers. And this is crucial, because historically, bonds have an inverse correlation with stocks. When the stock market is booming, bonds generally offer lower, steady returns. They're kind of boring.
Right.
But when the stock market tanks and investors panic, capital floods out of equities. Everyone searches for safety, so people flock to government bonds and high-grade corporate bonds. That sudden surge in demand actually drives the price of those bonds up.
Oh, wow. So while the 60% of your portfolio in stocks is dropping like a rock, the 40% in bonds is physically rising in value, cushioning the blow.
Exactly. It's an automatic stabilization mechanism. But she doesn't just buy U.S. stocks and bonds either. There's this behavioral trap called home country bias, where investors heavily favor their domestic market because it feels familiar.
Oh, totally. If you live in the U.S., you buy U.S. companies because you recognize the logos at the grocery store.
Right, you buy what you know. But to avoid tying her entire financial future to the fate of just one nation's economy, Shen diversified globally. She spread her ETF investments across the U.S. market, the Canadian market, and international developed markets.
Tracking things like the MSCI EAF index, which covers Europe, Australasia and the Far East.
Exactly. Broad global exposure.
Well, it's easy to hold a globally diversified 60/40 ETF portfolio when tech stocks are soaring and the economy is great. But a 60/40 portfolio assumes the market eventually recovers. What happens when the entire global financial system seemingly breaks, like it did when Lehman Brothers vanished overnight in 2008?
Yeah, the 2008 Great Financial Crisis is the ultimate stress test for this system, and the book uses it as a core case study, which I think is one of its strongest parts. Shen and her partner were basically watching their hard-earned net worth evaporate in real
I
time.
can't even imagine the stress.
The text details their initial panic, which is deeply, deeply human. I mean, everyone was panicking. But instead of liquidating everything and hiding cash under a mattress, they relied on the mechanics of their portfolio. They utilized a strategy called rebalancing.
And if we look at the mechanics of rebalancing, it's actually brilliant. Let's break it down. You start with a 60/40 split of stocks to bonds. When the stock market crashes, your stocks lose value. So they might now only make up, say, 40% of your total portfolio.
Right.
Meanwhile, your safe bonds have held their value or gone up, so they now make up 60%. Your portfolio is totally out of whack. To rebalance, you mathematically force yourself to sell the asset that is overweight, the bonds, and buy the asset that is underweight, the crashing stocks, to get back to your target 60/40 ratio.
And by doing that, it mathematically forces you to buy low and sell high. It takes human emotion completely out of the equation.
Which is the hardest part of investing.
Oh, absolutely. They kept investing during the decline. They were actively buying assets at rock-bottom prices. And because they trusted the math over the apocalyptic news cycle on TV, they recovered their losses in just over 2 years.
Wow, 2 years.
And they were perfectly positioned to ride the massive decade-long bull market that followed.
That's the thing. The wealthy have a system, and they trust the system more than they trust their own panic. They understand that downturns are essentially a fire sale on global assets.
It's when generational wealth is made.
Exactly.
Mm-hmm.
So the portfolio's built, it's surviving crashes, and it's growing. Now we run into an entirely different kind of friction, which is taxes. And just a quick note here for you listening. We are just unpacking Shen's specific strategies for navigating the existing U.S. tax code as it's written in the book. We're not taking a political stance on how the tax code should be written. We're just reporting on the math.
Right. Very important distinction, because Chapter 12 is bluntly titled, Taxes Are for Poor People.
Which is definitely a provocative title.
Very. But the core observation Shen makes is just mathematical reality. The U.S. tax system heavily favors the owners of capital over the providers of labor. Investment income like long-term capital gains and qualified dividends is taxed at a significantly lower rate than the standard earned income you get on a normal W-2 paycheck.
Simply put, money you make from your money is taxed less than money you made from your physical sweat.
Precisely. The tax code is essentially a rule book for a game. If you only ever earn a W-2 paycheck, you are playing by a set of rules designed to take a large chunk of your income. The book is urging you to start playing the game by the rules of the wealthy.
By shifting your focus toward accumulating investment income and utilizing specific accounts known as tax shelters and tax deferments.
Yes, and understanding the mechanical difference between those two is critical for wealth preservation. Let's look at a tax deferment first, like a traditional 401k or a traditional IRA. You contribute pre-tax money. This lowers your taxable income today, which is incredibly valuable during your peak earning years when you are in a high tax bracket. The money grows tax-free for decades, and you only pay taxes on it when you withdraw in retirement.
Presumably when you are in a much lower tax bracket because you are no longer earning a massive salary.
Exactly.
So it's basically kicking the tax can down the road to a time when it's much cheaper to pay. And a tax shelter is the reverse of that.
Yep. The prime example of a tax shelter is the Roth IRA. You contribute money after you've already paid your current income taxes on it, but the magic happens inside the account.
Right. The growth.
All the compound growth, all the dividends, all the capital gains happen completely tax-free. When you withdraw that money in retirement, you don't owe the government a single cent.
I've always thought the farming analogy works perfectly here. With the traditional deferment, you get a tax break on the seed, but you pay taxes on the harvest. With a Roth shelter, you pay taxes on the seed up front, but the entire massive harvest is yours to keep tax-free.
That's a great way to put it. And by utilizing both, you have incredible control over your taxable income in retirement.
Okay, so let's summarize where we are. You've optimized the career with the POT method. You've built the 60/40 global portfolio. You know how to rebalance through crashes, and you're shielding your wealth from taxes. At what specific dollar amount do you actually hand in your resignation? When is the finish line?
This brings us to the absolute holy grail of the FIRE movement, the 4% rule. This rule is derived from the Trinity study, which is this famous piece of economic research that tested various withdrawal rates against historical stock market data.
What do they find?
The rule basically states that if you save 25 times your annual living expenses, you can safely withdraw 4% of your investment portfolio every single year, adjusted for inflation, for roughly 30 years without running out of money.
Let's ground this in a real example for everyone listening. Say you track your spending and realize you can live a fantastic, comfortable life on $40,000 a year. You multiply that by 25. That means your magic number, your finish line, is a portfolio of $1 million.
Right.
If you hit that million, you can theoretically withdraw 4%, which is your $40,000 every year, and the compound growth of the remaining 96% of the portfolio will continuously replenish what you take out.
In theory, yes. But there is a massive hidden danger to this math. It is the absolute biggest threat to early retirees, and it is called sequence of return risk.
Okay, break that down for us.
Well, the 4% rule relies on average market returns over decades. But returns aren't average every year, they're lumpy. Imagine you hit your $1 million goal, you confidently quit your job, you pop the champagne, and the very next month, a 2008-style crisis hits.
Oh no.
Your portfolio drops by 40%. You now only have $600,000.
But your cost of living hasn't dropped. You still need that $40,000 to buy groceries and pay rent.
And this is where the disaster happens. You are forced to sell shares of your stock to get that $40,000 in cash, but because the market is down 40%, you have to sell significantly more shares to generate that same amount of cash. You are locking in those massive losses.
And because you sold those shares at rock bottom, they are gone forever. They aren't there to bounce back and grow when the market eventually recovers.
Exactly. You are permanently destroying the capital base that generates your income. If that happens in year 1 or year 2 of your retirement, you can run out of money in a decade.
That's terrifying. So how do you protect against that?
To survive sequence of return risk, Shen and her partner devised a dual defense system so they would never, ever be forced to sell stocks during a crash. The first component is what they call the cash cushion. They hold exactly 5 years' worth of living expenses in a highly liquid basic savings account.
Okay, but wait. Didn't we establish earlier that leaving cash in a savings account is like trying to walk up a down escalator? Isn't inflation just eating that massive pile of cash alive?
It's a natural objection. Most finance people would scream at you for holding that much cash. But you have to shift your perspective on what that cash actually represents. The cash cushion is not investment designed to generate a return. It is an insurance policy.
I see.
Yes, inflation will slowly erode its purchasing power, but the cost of that inflation is essentially the premium you pay to protect your core multi-million-dollar portfolio from sequence of return risk. They calculate that 5 years is roughly the maximum time needed to ride out a severe market downturn based on historical recovery patterns.
That is brilliant. You are paying an inflation tax to guarantee you never have to sell stocks during a panic. That makes total sense. And this cushion is supported by the second part of the tense, right? The yield shield.
Yeah, the yield shield. This involves recalibrating a portion of your portfolio away from pure growth stocks and into higher yield investments that throw off consistent cash. We are talking about things like preferred shares, corporate bonds, and real estate investment trusts, or REITs.
And a REIT essentially lets you earn rent from commercial real estate properties like malls or office buildings or data centers without having to actually buy or manage a physical building yourself.
Exactly. And they also use strong dividend-paying stocks. A dividend is just a mature company sharing a portion of its cash profits directly with its shareholders. So the goal of the yield shield is to generate actual cash, income dividends, interest, and rent. That gets deposited directly into your checking account every month or quarter.
Wow, okay. So between the natural cash flow generated by the yield shield and the 5 solid years of living expenses stored in the cash cushion, they built a total financial fortress.
It really is.
If the market crashes the day after they retire, they don't have to sell a single share of their S&P 500 ETFs at a loss. They just live off the cash generated by the shield and the reserves in the cushion until the market finally recovers.
It's bulletproof.
Financial freedom, as mapped out here, really is a highly engineered machine. It's not about hoping for a windfall or getting lucky on crypto. It's calculating the ROI of your career with the POT method. It's building an engine of low-fee ETFs on a 60-40 split to capture the growth of the global economy while using bonds as a shock absorber. It demands you manage your emotional panic during crashes by mathematically rebalancing. You play the tax game using shelters and deferments to protect your harvest. And finally, you defend your 4% withdrawal rate with a 5-year cash cushion and a yield shield.
It is a masterclass in modern personal finance, truly. But, beyond all the mechanics of ETFs and tax shelters, I think the most valuable takeaway from the book is the challenge it presents to the conventional narrative of why we even work in the first place.
Yeah, what's it all for?
Right. Let's say you follow this math flawlessly. You hit your 25x expenses number tomorrow, and the sequence of return risk is completely mitigated. What do you actually do on Monday morning when you don't have to log into work?
That's the real question.
Because true financial independence isn't about quitting work to just sit on a beach drinking margaritas for 40 years. It's about finally having the leverage and the freedom mindset to choose what your life's work actually is without ever needing it to pay the rent.